All right. First off, I want to talk to you about some of your thoughts about the fact that we could see a fifth summit between the U.S. and China. Tariffs, trade have had a big impact on the markets this year. Remember the April lows and the rebound since then. Does that give you confidence that there's going to be a deal that's going to be positive for the markets coming up?
Well, I think, we're all holding our breath a little bit. I know we've had a lot of these summits, a lot of these talks. I think just even the resolution on TikTok would be a huge step forward in having confidence that we might even to be able to get a little farther forward. But any certainty would finally just give markets a little breather, because it has been so hard just to estimate where are these costs going to go? Right. Exactly how much are we going to have to raise our prices?
Breather or a boost? Because the market hasn't taken a breather. We just hit new all-time high. So a boost, you're saying, would be another leg up?
I think, no, it's more about just being able to do some financial planning, because we've just seen initially we had massive cuts in estimates, none of which materialized. Obviously, we had a record second quarter, record beats, because we were able to still see profits. And so it's more just about visibility about how to plan for 2026. Do we need to raise those prices? What kind of inflation are we going to see? And just, is it going to be one and done, or is it going to trickle out over the next 2 years?
So how are you telling your clients to prepare for the expectation of rate cuts? I think pretty much expects a 25 basis point cut at least coming up tomorrow when the Fed meets, maybe even more cuts going ahead. With that in mind, do you go put money in cyclical sectors? Do you put money in some unloved parts of the market with the idea it could broaden out? Or do you stick with what's been working, is working this morning, in all honesty, tech?
So for us, it's more about really thinking about not the sectors as much, but more about spreading it across different capitalizations, because obviously the small and the mids have massively underperformed for the past 3 years. And so for us, having a new series of rate cuts could really be the ones that help those smaller cap companies. Those are the guys that are having the short-term loans, so they're affected by those short-term rates more closely than your larger. And so those are the ones that can really have that boost. And we've done some studies where when the Fed cuts by 200 basis points, and obviously they've already done 100, it's been really drawn out. But if we get another 100, that's really that critical ticking point for companies to really be able to get those loans, more CapEx, and have that growth.
So I'm going to go to your word of the day. Your word of the day is CapEx.
That's right.
But it sounds like your pick is small cap stocks. It seems like almost counterintuitive, because most of the time we talk about CapEx, we're talking about mega cap tech. But you're saying you're seeing the opportunity in small caps.
Honestly, in small and mid caps, we're still talking billion-dollar companies. These are companies that are really looking at very important, where CapEx is extremely important. So I know we'd love to talk about the $300 billion CapEx spending of Oracle, but little companies do it too.
That's fair.
So and that is my word of the day.
Very quickly, because we got to get going. But are small caps, do you see those as the biggest beneficiary of this upcoming expected rate cut? I don't want to keep saying it's going to happen, but the expected rate cut.
I don't think it's going to be this cut. I think it'll be when we get further into cuts in 2026. And that's why we're talking to our clients now, is to be ready to reposition your portfolios for 2026. I think, again, once you get finally into 200 basis points of cuts, which should be early next year, that's when you're really going to see them fly off the shelves. So get ready now.